Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Easing the pain, President Trump plans measures to soften the blow of auto tariffs. Carney wins Canada. Anti-Trump sentiment secures a win and a dramatic turnaround for the Liberal Party. And coming up this hour, an exclusive interview with Goldman Sachs CEO David Solomon at the Norwegian Sovereign Wealth Fund's annual investment conference. Well, it's been 5 consecutive gains for the S&P 500. We attempt to make it 6 this morning. Tech has been lagging ahead of their earnings tomorrow, but now it matches the S&P 500, up about 0.2%. We'll get Meta and Microsoft tomorrow. We also have that White House story earlier confirming the Wall Street Journal story on relief for auto tariffs, that helping to lift futures this morning. 10-year treasuries, those have also gained for 5 consecutive sessions. Do we end that today? Yields are moving higher, 2.8 basis points for your 10-year yield. That stands at 4.23. We do have Scott Bessent talking about more deals to come and a tax proposal for the U.S. Let's look underneath the surface here with your stocks to watch. Is Bloomberg's Valerie Teitel. Good morning, Valerie.
Danny, good morning. Let's start off with the U.S. auto sector. Really enjoying these headlines around the softening of stance on the auto tariffs from President Donald Trump. We're seeing shares of Ford rise 1.2% in pre-market trade. Also shares like GM and Stellantis doing well pre-market. Let's head over to Germany, though. The story is a different picture for a German luxury automaker, Porsche, issuing yet another profit warning. Danny, it's third this year. Shares are falling around 5%. One of the biggest losers in the stock 600 today. They also warned that price hikes might be coming as they look to battle these U.S. tariffs. Lastly, Danny, let's end on the stocks that are reporting before the bell because we continue to get more news on the auto sector. We also have GM reporting in just over an hour's time, also followed up by Pfizer and Coca-Cola for perhaps a read on the U.S. consumer. All three of these, the big ones, reporting before the bell this morning.
Yeah, in the deluge of earnings season. Val, thank you so much. Bloomberg's Valerie Teitel. Now, as market volatility persists, Ed Cole, head of multi-strategy equities at Man Group, writes, quote, "The lessons I have taken from 20 years suffering in EM investing is that once you unleash disruptive and policy volatility, it's very hard to put it back in the box and restore confidence with the same government in place." I'm pleased to say that Ed joins us now. Ed, I always love this perspective that you bring to the conversation. But look, I could argue things have settled down. You don't have that toxic brew anymore of yields higher, stocks down, and dollar weaker, and things are back to normal. But you say the damage is done. Why?
Look, I think that businesses, economic agents require transparency generally. We're in a world, we seem to be in a situation today where, the US government's kind of rolling back a little bit from some of its most aggressive policy announcements, and just overnight with the auto tariffs, more of the same on that. And so markets like that. But ultimately, if you're planning investment, which is what makes economies tick, you need to understand that you have a predictable landscape that you can understand is going to be in place for, a long period of time. And I don't think that's really what we've got. I think the flip-flopping is problematic. And I think we're going to see that. I mean, we already are starting to see that come through in earnings revisions. So analysts who are looking at corporate earnings in the US have revised their expectations down materially in terms of the volume of downgrades. So we're now at a point where pretty much earnings revisions for US equities are as negative as they've been at any point outside of a recession in the last 25, 27 years. Earnings expectations themselves have not come down very much, really only about 1% down from the top of the 1-year forward earnings expectation integer. And there's probably a lot more to come. I think, businesses are not likely to be particularly confident in this environment because they just don't understand the lay of the land and they don't understand how they're expected to allocate capital.
How long does that need to persist, Ed, before we see businesses not just pulling back on CapEx, but revisiting their hiring plans, things that might get us more worried for a more protracted economic downturn?
I mean, that's the big worry. I was part of the kind of inevitable recession in 2022, 2023 brigade, which was wrong. But my worry then was that, as inflation rose, that the lever that corporates would be left with was managing their cost base, which is a kind of euphemism for the sadness of letting people go. That time around, it didn't happen because end demand was so robust from all of that post-pandemic saving. And this time around, we're in a probably slightly stickier inflation environment. I think, the Fed is trying to work out the extent to which it can look through that. But, inflation expectations are moving a bit higher. And at the same time, expectations of real growth are moving lower. The statement of economic projections for March that came out is showing that the Fed has got less confidence in growth. So from a business perspective, if your end demand's falling and your cost base is rising, sadly, that normally does mean that you need to retrench. That would likely be, if we're going to see a recession, that would likely be the cause of a recession in the US.
Ed, you don't sound like someone who's particularly keen on American equities, just given everything you've said. What are you doing with your allocation when it comes to geographic makeup?
Yeah, Man Group has this sort of credo that we don't have a house view, and we really don't. We're a place where we want everyone to, think creatively about investing problems. The closest thing we have to a house view is embracing diversification. So, we've kind of, as many people have done, we've looked at this growing concentration in equity markets, both within the US and the US as a part of the world, for a long time, and thought that's problematic because it leaves, in equities at least, it leaves the investment decisions that big plans need to make to outperform in equities. It comes down to, a few decisions on a few stocks, which is not particularly, I think not a comfortable place for big allocators to be. Ultimately, we believe in, diversifying risk, which in equity allocation means perhaps thinking about ways to be exposed to equities that don't force you into concentration. We like risk premia, like low vol, max diversification. So basically, building a portfolio of cash equities, which is massively diversified rather than following an index. And you can do some pretty clever things with leverage to make sure you get the right amount of beta to continue to outperform. Ultimately, though, over the long run, I think if we take that back to what we think allocators are doing and are talking about, we've had an over-concentration of capital in US assets. And that's been driven by superior earnings performance and innovation. But, those things are now being questioned. And I think what we're going to see, not necessarily in the short term, but over, multiple years now, is that capital has to reallocate away from the US to the rest of the world. And there are lots of interesting things going on in the rest of the world. Just yesterday, there was a huge announcement of corporate consolidation in Japan in the industrial space, unlocking some of those inefficiencies you've got there through the kind of balance sheet and cross-holding between Japanese industrial groups. There's lots of idiosyncratic stories in the world. There's still, I think, an interesting story in the medium term in China. Obviously, there's European fixed capital investment, and all of these things are happening at a time where we think, at least, allocators are going to need to start thinking on a multi-year time horizon about bringing capital, to different geographies.
Ed, what I'm hearing from you, though, is what you're looking at in just that decision alone is some of the innovation, not necessarily waning in the U.S., but coming from elsewhere, valuations and concentration too high. Does that mean that you would be really rotating away from the U.S. or diversifying, looking elsewhere, regardless of what's happening in the White House?
Yeah, I think so. I think that's a really good way to put it. I think this is a catalyst. The kind of excess concentration has happened. It hasn't happened because of the White House. It's happened for good reasons. That's always the reason that things become over-concentrated. There's always a good story. The catalyst now is the White House, but we've been preaching diversification long before the White House made life more difficult for allocators. I think it's just a reminder, right, that if you end up overly concentrated in either a geography or a group of stocks, because these kind of mega cap stocks are all in the same groups in consumer discretionary or technology, that when the tide goes out on that, when what turns from a tailwind to a headwind, life becomes more difficult. So, yeah, we preach, irrespective of the White House, we preach diversification, and now is a good reminder of why you get paid for it.
Ed, a masterclass. Thank you so much for joining us this morning. Please come back again soon. Ed Cole of Man Group. By the way, we heard similar noise coming from George Salavrios of Deutsche Bank saying that buyers remain on strike of U.S. assets. Okay, some other top stories trending on the terminal this morning. Deutsche Bank's trading unit notched a record first quarter, getting a boost from market volatility. Revenue for fixed income and currencies jumped 17%. Deutsche Bank's CEO said the results put the bank on track to deliver its targets this year. Elsewhere, China says that it's willing to cooperate with the U.S. after the spat over Boeing. The country's Ministry of Commerce said it's willing to support normal ties with U.S. companies. Earlier this month, officials told Chinese airlines to reject deliveries of new jets from Boeing. And talks are progressing between the U.S. and Iran. For the first time in decades, Iran is pitching its sanctioned economy to President Trump as an investment opportunity worth trillions of dollars. Top Iranian officials are overtly angling for a better nuclear deal with Washington than the one Trump had canceled in 2018. Coming up, autos on the rise pre-market. President Trump offers the sector another reprieve. We're going to bring you the latest on Bloomberg Brief.
I think it could be as early as this week or next week. Vice President Vance was in India last week, and negotiations are coming along quite well with them. As I've mentioned, some of our Asian trading partners have come with very, very good deals. We're evaluating those.
Treasury Secretary Scott Bessent there speaking outside the White House yesterday. And shares in U.S. automakers are gaining in the pre-market session by as much as 3% for Stellantis. President Trump offered the sector a reprieve from tariffs. Commerce Secretary Howard Lutnick called it a major victory for the president's trade policy. For more, we're joined by Bloomberg Global Business Editor Josh Galoo. Josh, just how much of a reprieve exactly is the Trump administration giving the auto sector?
Well, it's definitely welcome news. And, you already see comments from Ford and GM confirming that they get parts that are manufactured abroad. They have there are others like Volkswagen and BMW that make cars in the United States, but their supply chains go outside of the boundary. So, these supply chains that they've set up over decades are now in deep trouble. So the extent to which the reprieve the Trump administration is giving now is going to affect their businesses there. It's certainly welcome, but it's also a tiered approach. So they're kind of avoiding the worst case scenario. Basically, what the Trump administration is poised to do is to avoid this stacking of tariffs, where imported cars would not only be taxed from the import, but also suffer the steel and aluminum tax that they have. And at the same time, cars manufactured in the U.S. are going to get a bit of a easier deal on foreign parts that they bring in, and that's going to be tiered over time. The administration says to give them time to relocate their production to the United States. So it's not a full reprieve, but it is something that's very welcome to car manufacturers that are on the edge right now.
And something I'm sure a lot of other corporates would like. I got to say, Josh, it does seem like Secretary Bessent is the one who's setting the agenda. He also talked about this goal of a July 4th deadline to pass Trump's multi-trillion-dollar tax cut package. Let's just take a listen to the Treasury Secretary.
We're going to be having a tax meeting today, but what you can see is that as we go into the tax negotiations or the final stages of the tax bill, we're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
Josh, there does seem to be a real concerted effort from the administration to shift the focus back on tax policy.
Absolutely. President Trump's polling numbers have just cratered during this tariff war. Fewer than 40% of respondents in many polls are saying they approve of his handling of the economy. That puts him in a tough position. It's the lowest approval rating on the economy he's had in both terms. So, on the one hand, it's important that he, for his own popularity and for political expediency, returns to some of those campaign promises that are really popular with Republicans, like his tax cuts. And at the same time, the government's coming up on a deadline this summer, August or September, where it's going to need to extend its debt. So it's important that they're moving their tax cuts through Congress in a way that's completely tied to lifting the debt. So that they're trying to move that forward. They have to in some ways, but the administration wants to go even faster than Congress has signaled that they wanted to go. The House aims to pass its version of it by Memorial Day, so the end of next month. And then, of course, there are things to be decided with the Senate to make it move forward. And the administration wants that to happen before they go on their August recess. But there are a lot of details about what cuts to make to be able to afford the tax cuts, the extension of Trump's 2017 tax cuts, but also additional cuts that he wants to layer in. The no taxes on overtime, no taxes on tips, deductions for auto loans. That is going to cost, and up to now, it's unclear how they're going to pay for it, other than massive tax to social programs.
Yeah, I mean, look, a lot of things to figure out in a short time. That is Bloomberg's Josh Galou. By the way, just a headline coming from Punchbowl, pointed out by a great production team, Amazon to show the cost of Trump tariffs on each product. What will that mean for the American consumer as they look line by line of the added cost of tariffs? We already know some of the fast fashion companies like Shein, the e-commerce companies like Temu from China, also adding in the price of tariffs. Okay, coming up, a victory for Carney, what the win means for Canada and its relationship with the U.S. That's coming up next on Bloomberg. Let's take a look at the front pages this morning and what's making headlines in various outlets. First up, we have this on the Bloomberg. Full power is being restored, or has been restored rather, to Spain after a huge blackout. Just moments ago, the country's operator said the power system is back to normal. Portugal's power has been restored for all users as well. The cause of that blackout, it is still unknown. The government said it's not ruling out any possibilities. Next up, the FT has this, that HSBC is increasing provisions for bad loans. It's also forecasting muted lending for this year. It cited uncertainty, market turmoil, and a deteriorating economic outlook from higher tariffs and geopolitical tensions. They also announced a $3 billion buyback for shareholders. And the top story, I should say, on basically every front page, that includes the New York Times, the Wall Street Journal, Mark Carney winning a narrow victory in Canada's election. Carney's party won about 43% of the national vote, but may fall short of a majority in the House of Commons. He spoke to supporters shortly after the victory.
I have a question. Who's ready? Who's ready? Who's ready to stand up for Canada with me?
Joining us now for more on this is Bloomberg's Roz Matheson. Roz, just how massive of a turnaround was this for the Liberals to come back and secure the prime ministership?
Well, as you say, it was quite a turnaround, because only months ago we had the Liberals under Justin Trudeau really lagging in the polls, struggling with an economy that's been in difficulty, in a sense that this was the Conservatives' election in a way to lose. But we saw under Mark Carney the change in leadership, helped possibly a bit by the environment with the US and tensions there, that Canadians really moved back towards the Liberal Party. And of course, Mark Carney now winning the election. But it wasn't quite the victory perhaps he was looking for. As you were noting, it could be that he's facing a minority government, yet another minority government in Canada, which will make life harder for him, obviously, as Prime Minister. And the Conservatives performing relatively well in all of that, taking some ground in Ontario, Toronto as a whole. And also, we're just hearing with projections that the Conservative leader, despite the performance of the Conservatives, he may lose his own seat. So again, there could be changes coming for the Conservative Party in all of this as well.
There was a sense, Roz, that this election was just as much about who is in Ottawa and versus who is in the White House. Mark Carney yesterday saying our old relationship with the U.S., one based on steady integration, is over. What does it mean in terms of his victory in saying those things and getting the boost from Trump's anti-Trump sentiment about how Canada and really the rest of the West is going to be treating Donald Trump and the pushback against him?
Well, certainly Carney lent into that in the campaign, saying he would stand up to Donald Trump on trade. He would diversify Canada's trade with the rest of the world, including Europe and in Asia, because, of course, the Canada trade relationship is very intertwined with the US. So he lent on that very much in the campaign. And for a lot of Canadians, these tensions with the US are very visceral. They're very personal. This sense that Trump keeps saying, I can just make Canada another state of America. And so that may have been a rallying cry for voters. But equally, some voters will be concerned. We can see that in some of the voting patterns, that the tensions with the US and by standing up to the US might hurt the Canadian economy further, an economy that's already, again, in those difficulties. So those are twin factors at play. And beyond the US and all of this, there were those long-term concerns in Canada for voters around housing, access and also about migration, cost of living, and those were still bubbling there alongside the US issue. So possibly did give Carney an extra push in their campaign, but there are big challenges ahead when it comes to the economy.
Roz, thank you so much for that update. That is Bloomberg's Roz Matheson. Now, futures continue to move higher this morning, getting some help from some easing of auto tariffs. Futures up just 0.1%. Coming up on the show, our exclusive interview with the Goldman Sachs CEO, David Solomon. Francine Lacqua sits down with the chief executive from the Norway Wealth Fund Investment Summit. Stay with us for that. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Easing the pain, President Trump plans measures to soften the blow of auto tariffs. Carney wins Canada, anti-Trump sentiment secures a win, and a dramatic turnaround for the Liberal Party. And coming up in just a few moments, an exclusive sit-down with Goldman Sachs CEO David Solomon at the Norwegian Sovereign Wealth Fund Annual Investment Conference. 5 consecutive gains for the S&P 500. We attempt to make it 6 this morning, getting a boost from the White House confirming an earlier Wall Street Journal story on relief for auto tariffs. Tech, that had been lagging ahead of their earnings tomorrow. We're going to get Meta and Microsoft. They're dead even with the S&P. When it comes to this bond market, U.S. Treasuries have also gained for 5 consecutive sessions, but we look to snap that this morning with yields moving higher. By the way, yields closed yesterday at their lowest in 3 weeks. We're higher by 1 basis point for your 2-year. For your 10-year, it's just over 2 at 4.23%. Let's look underneath the surface. Here with some stocks to watch is Bloomberg's Valerie Teitel. Hi, Valerie.
Hey, Danny, good morning. Let's start in Germany. We've had one of the German lenders reporting this morning, Deutsche Bank, showing record profit for their trading desks. Again, this theme that trading desks across the street have done very well with the market volatility in the first quarter. There was a little bit of a warning under the hood, though, the CFO telling Bloomberg that their deal pipeline slowed dramatically in April. So that stock did temper some of its rally. I'm still in the green, up 1.6%. Let's stay in Germany, move on to defense, because the darling of the defense stock rally in Europe reporting a blowout first quarter earnings release. Though stock is rising near 6.5%. Danny, want to end on what's ahead. We've got 3 big companies reporting before the bell, starting with the auto sector, General Motors, in just an hour's time, moving to the pharmaceuticals with Pfizer, and lastly, Coca-Cola. Focus will be on their organic U.S. sales guidance, and what could that possibly tell us about the health of the U.S. consumer?
Valerie, thank you so much. That is Bloomberg's Valerie Teitel. Now let's head to the conversation of the morning to Oslo for the Norway Wealth Fund Investment Summit. Bloomberg's Francine Lacqua is standing by, one of the top voices in the banking industry. Francine.
Thank you so much, Danny. I'm delighted to speak to the Goldman Sachs Chief Executive, David Solomon. David, thanks so much for joining us. First of all, welcome to Oslo, Norway. I know we'll talk about Europe, but we have to start with Trump policies. It's been 100 days since the inauguration. Where are we? We've seen a lot of volatility. How would you describe this moment in time?
Well, first of all, thank you for having me, and it's good to be with you, here in Oslo. We're 100 days in, and I would say there are a handful of policy initiatives that are being put forward. Some of them certainly are very, very interesting and intriguing to the market. But what's been put forward on trade so far has raised the level of uncertainty very significantly. And so I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. And I think it's going to be important that we get more clarity on the direction of travel from here.
What, for the markets? So if you look at markets, there's been a sell-off, a pretty dramatic sell-off in U.S. assets. It's somewhat come back, but has it been too drastic?
Well, it's not just for the markets. First and foremost, it's for businesses, it's for individuals. When there's a high level of uncertainty, people tighten their belt, they invest less, they spend less, and all those things slow down growth. And so, one of the things that has happened over the course of the first 100 days is that the perspective on forward growth has been decreased. And so when you decrease, that perspective on forward growth, that changes investors' perspective of equity values. So what we've seen is a relatively orderly kind of repricing of equity assets. And what's unusual in the context of this repricing is generally when you have that kind of equity market stress, people run to treasuries or safe haven, but here we're seeing a slightly different rotation. Because of the nature of the policy, we've seen a weakening of the dollar, at the margin. And so that's been different than I think what people expected.
Well, are treasuries still a safe haven?
I think U.S. treasuries absolutely are a safe haven. But you can reprice a safe haven asset as people's preferences shift slightly. I think at the margin, we've had for a long period of time a trend of capital flows into U.S. assets. And, at the margin, people are looking at their portfolio constructions and saying, given the uncertainty that's been raised in the U.S., do we want to rebalance that a little bit? And I'd say the rebalancing so far has been at the margin. Investors can rebalance their portfolio in two different ways. If you're over here in Europe and you have a European investor, they can sell U.S. assets, but also if the relationship between the dollar and the euro changes, that rebalances their portfolio weighting too. And so we've seen that over the course of the last few weeks.
But David, so investors are asking a risk premium, a pretty hefty risk premium to own U.S. assets at the moment, even if there's a reversal in terms of tariffs. Does it come back to what it was like, or is there a permanent change?
Well, I'm not sure that they're asking a pretty hefty risk premium. They're certainly asking a different premium than where we were 3 months ago. But I think everything's got to be looked at, in a broader perspective. The moves have been real in terms of the repricing of equities, particularly some of the growth stuff, the Magnificent Seven, some of these stocks, that really led the last rally. But I'd also, step back and just say, when you look at where stocks were a year ago, when you look at where stocks were 6 months ago, we had a big move up in the early part of the year, and we've kind of reset to kind of where we were, 6 to 12 months ago. What's really important is people need to understand the policy set going forward and the prospects for growth going forward. And at the moment, as I said to you a few minutes ago, the level of uncertainty is just too high. And so until we have more certainty about the policy directive, it's hard for you to see, more capital allocation, more investment.
Does the dollar remain a reserve currency?
Absolutely.
In 10 years, 20 years?
I absolutely think the dollar is going to be the reserve currency, but the value of the dollar relative to other alternatives can shift. And I do think over time, the U.S. needs to be very focused on our levels of debt, our deficit spending, et cetera. And I think to the degree that we don't handle that appropriately, it can put more pressure on the dollar. But I don't see a scenario in the near term where I think it's likely that the dollar is not the reserve currency for the world.
So I know you're basically saying, look, keep a cool head until we have a better understanding, right, of some of the policies put in place. But what does it do to the U.S. economy going forward? Does it mean, does the Fed need to cut rates because of uncertainty on growth?
Well, I think it depends. Goldman Sachs has lowered its growth forecast from 2% to 0.5%. It's not clear how this will all play out in the coming months. No one really knows. But to the degree that the economy slows, ultimately the Fed will try to act to buffet, some of that slowdown in the economy. To the degree that we go into a recession, that will lead to a different reaction. So again, the Fed will look at the data, will look at the information, they'll look at labor, they'll look at growth, and they'll make decisions based on that. Everyone wants to project forward and know the answer. We're at a moment in time where it's more uncertain than makes everybody comfortable. And I just say it's a moment in time. Let's, step back. Let's see how some of these trade deals are cut. Let's see what policy actually does go into place. And that will help us better understand the forward growth trajectory. But it's clearly been slowed by these actions. And as I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off, employees and running their businesses tighter because of this level of uncertainty.
But were you surprised, and are your clients surprised that it's hit growth maybe more than inflation?
I think you're going to have pressures on both fronts. But again, it depends. It's one thing to talk about reciprocal tariffs, but from an inflationary perspective, it actually depends on what tariffs go into place. With respect to growth, there's no question the uncertainty slows down growth. And so everyone's growth forecasts have come down. By the way, not just in the U.S., this affects global growth everywhere. And so the forward trajectory of growth, given the current policy initiatives, has slowed. And now we're going to have to wait and see how this all moves forward to have a clearer sense of how much, how long, et cetera.
Where's China in all of this?
Well, China's a hugely important trading partner, to the West, to the U.S., to Europe. At the moment, we're in the early stages of what I think is an obvious negotiation between the U.S. and China, and we need more clarity. But the current state of affairs is not sustainable, and so that's why I think there'll be some change. You're starting to hear the administration, talking about the fact that there needs to be change and what's in place is not sustainable. But no one knows exactly how this would play out at the moment, and that's increasing the level of uncertainty.
David, when you look at a lot of investors, and I think also Goldman Sachs did quite a lot in the Middle East, is this one of your main points of focus? And is that in case things dry up in the U.S., or is it just business sense to go for the Middle East right now?
Well, the Middle East is a very, very interesting business opportunity for a firm like Goldman Sachs. They have enormous capital resources that they export around the world and they invest. We run a big asset and wealth management business, and there are many of these Middle Eastern nations and their pensions and their funds are partners of ours and other asset management firms all over the world. I think that continues. It's not a function of the U.S. drawing. The U.S. is 35% of consumption in the world. That's not changing. Okay, that's not changing. The U.S. is a very, very attractive market. I think Middle Eastern investors appreciate that opportunity as they appreciate opportunities in Europe and other parts of the world. I think one of the most interesting things about what's going on is it would be really good for global growth and good for the global economy if Europe can make more progress on capital markets reform, European champions really bringing together and harnessing the power of the European Union. And one of the things I'm encouraged by as I'm over here visiting in Europe right now is I definitely take away a sense of resolve, of excitement about actually moving forward, breaking down some of the regulatory barriers that have been an inhibition to growth here. And I think that would be quite constructive. And more stimulative fiscal action here in Europe also would be quite constructive for growth. So, there are gives and gets, but it would be really terrific to see some progress on the economic trajectory of Europe holistically here. And I'm encouraged by some of the things I'm hearing from our clients over here.
Where do you see opportunities in Europe? And again, is there like a 6-month window where if Europe doesn't get its act together, it's just too late?
No, I think, there's never just a 6-month window. Okay, here or in the U.S., it's a great soundbite, but these are big, important economies. I do think that European growth has been hampered by a very complex regulatory environment, particularly in Brussels, and by a sense that many of the nations have acted, more nationalistically than holistically. I think given what's going on with the U.S., there's really a push to break down some of that regulatory bureaucracy, to really think about how European champions can be bolstered and there can be more investment. And I think that's a big opportunity. There's more tech innovation going on here. It doesn't quite match up or compare to what's going on in the U.S., but there's more opportunity here. And so, I'm hopeful that this is a moment in time where we can see greater investment and a greater sense of the opportunity of Europe holistically. And that would be quite constructive for global growth if we could see some progress on that.
Talking about regulation, what are you expecting regulation for banks to look like in the U.S.? Does DOJ rip up some of the regulators?
Well, I think we saw an enormous pendulum swing in the last 4 years toward a much tougher financial regulatory environment in the U.S. I don't think it was constructive. And I do think, from a positive perspective, this administration would like to reset that. I'm hearing some very constructive things along three fronts. One, obviously, is the leverage ratio, which is very, very important for the Treasury market. Two is on the capital regime and CCAR and GSIB and the construct of how bank capital is calculated. And third is just on the supervisory process. Supervisory process should be focused on ensuring that we have a safe and sound banking system, and it shouldn't get distracted into other areas. And so I'm encouraged by what I hear out of Treasury. I'm encouraged by what I hear more broadly. And so I do think there's an opportunity to take that pendulum, which really was an inhibitor to growth, free up some capital, get that capital recycled into the system, increase lending activity. And so I'm quite constructive that we're going to see some positive change on the front of financial regulation in the U.S.
How quickly could that come?
I think we'll see the beginnings of that in the coming months. And certainly if you and I were sitting here a year from now, I would hope I could point to a handful of very specific things that have swung that pendulum back to a more constructive place.
I mean, do you think Europe then follows suit in deregulating at the margins, or otherwise it puts European banks in a very difficult position?
Well, I think one of the issues for Europe is that the banking system in Europe has not come along over the last 15 years the same way as the U.S. banking system has. When you look at Europe, whether you're looking at, BNP is probably the largest European bank with probably a $75 billion market cap, today. UBS would be larger than that, but just over 100 billion. There are obviously lots of institutions in the United States that are bigger, broader, much larger market cap banks. And so in the context of that, consolidation and growth in Europe and a capital markets union in Europe would be a very constructive thing for the capital markets more broadly. But Europe's been slow to make progress in that. I'm hopeful that we'll see more progress in the coming 12 to 24 months.
Dave, there's a lot of talk about credits and, of course, private equity and some of the alternative investments that also Goldman's trying to take advantage of. How much does that grow in these uncertain times?
Well, when there's a higher level of uncertainty, the growth of private capital slows, just like the growth of, asset management business and public capital slows too when there's uncertainty. But I think the long-term secular growth trends around private capital formation are solidly intact. And if you step back and you step out of this moment in time, I think with a 5 or 10 year view, we still have very good secular growth in private capital formation. With respect to private credit, we haven't had a credit cycle in quite some time. If we have a real economic slowdown or ultimately a recession, you will have a credit cycle. We'll have to manage through that. But with a 5-10 year view, I still think growth in private capital formation is a long-term trend that's firmly in place. And a firm like Goldman Sachs and what we do in our asset and wealth management business is very well positioned to benefit from that.
We often talk about a canary in the coal mine, or is there anything in either private credit or anything that you're watching out for an indication of a significant souring, I guess, of the economy or markets?
What has happened that we're all watching is the level of uncertainty has changed the prospects for growth in the short term. And as a result of that, companies slow down capital plans. People, because they have less confidence, spend less. I think there was evidence in late January, early February that when you looked at certain consumer discretionary businesses, we were starting to see a little bit of slowdown. Obviously, with the level of uncertainty we have now, that's been accelerated. And so, there's no canary in the coal mine. Fine. The prospects for growth are slower. And as a result of that, investment will be slower. And until there's more confidence in the policy path forward, we're going to have to manage through a slower growth environment.
And so M&A and IPOs will take a backseat.
Too strong a statement again.
Are you telling me I'm too punchy as a journalist?
Well, it's your job to be punchy. It's my job to try to listen and try to find some balance. Capital markets activity was up year over year in the first quarter. M&A activity for deals above $500 million, so the kind of M&A you and I talk about, was up in the first quarter year over year. Sponsor M&A was up in the first quarter year over year. I think it depends on where we go from here. If you look at the month of April, there's still been a reasonable amount of M&A activity. IPO activity is slower given the level of uncertainty. If the level of uncertainty grows from here, yes, you won't see the same amount of capital markets activity. But my own belief is things will settle down. We'll have a clearer policy perspective, and some normalization of capital markets as we shift into 25 and 26. Even if we have a slower economy, or even far worse, we have a recession, ultimately, when the market adjusts to that and resets, people need to transact, they need to raise capital, they need liquidity for their investments. And so part of this is just a reset of expectations, and we're in the process of that happening.
I mean, given all of this, where do you see hiring and firing in what divisions and where geographically at Goldman's?
Well, I think this firm always, manages its headcount with a long-term perspective, and we will continue to do that. I think that in an environment like this where there's more uncertainty, we probably control our headcount by doing less hiring, not by, at the moment, based on what I see, doing more firing. But I do think one of the things that the labor force broadly will have to deal with when there's uncertainty with companies, and I'm hearing this from CEOs more broadly, CEOs tighten their belts. And when CEOs tighten their belts, they get focused on expenses. And so I think we're going to go through a period here in 2025 where expense management is going to be more in focus for CEOs running big businesses than capital investment. And if we get more certainty as companies head into their planning processes in the summer, that might change. But if we have the level of uncertainty we have now, that probably won't change in 2025.
David, thanks so much for joining us. That was David Solomon, Chief Executive Officer there of Goldman Sachs. Danny, with that, I'm going to send it back to you, of course, in New York, and we'll have plenty more throughout the day or here in Oslo, Norway.
Francine, thank you so much for that excellent and really wide-ranging conversation. Francine Lacqua speaking with David Solomon of Goldman Sachs. A plea really from the Goldman chief executive to have some certainty back into the tariff and policy negotiations, saying that he was hopeful that U.S.-China conversations and negotiations, that it was obvious that they were underway. Now, on that note of U.S.-China trade war, it does seem like a moment where China is digging in its heels. China's foreign minister warning that emerging market countries against caving into U.S. tariff threats. Speaking at a BRICS meeting in Brazil, he told the group to choose to remain silent, and compromising will, quote, only make the bully push his luck more. For more, Alan Wong, Bloomberg China economy and government editor, joins us now. Alan, there were also some headlines coming in recently from China basically saying for the pharmaceutical sector, look elsewhere beyond the U.S. to find resources. To what degree is China preparing for the long term to dig its heels in and not necessarily make deals with the U.S.?
That's right. There are two things happening at the same time. China is digging in and preparing for the protracted trade war. But at the same time, it has insisted that it's open to trade talks, given certain conditions. And what those conditions are is that any trade negotiation must happen on the basis of equality and mutual respect. Whether the U.S. meets that bar right now or will do so in the near future remains to be seen. But one thing that we know for sure is that Wang Yi, the foreign minister, is standing firm and telling BRICS countries that they too should resist what Wang said that is bullying by the U.S. And it's in China's interest that other countries don't cut a deal at China's expense, obviously. And his speech signaled that Beijing is willing to continue the stalemate. And so the sort of uncertainty that Goldman Solomon talked about, I'm afraid, is going to continue for a bit.
Well, it was interesting. We heard from Treasury Secretary Scott Bessent yesterday speaking to the American media, saying that there were conversations on all levels happening between the U.S. and Chinese officials. Alan, have we heard anything similar from the Chinese side? Do we understand to what degree the countries are actually talking?
Well, this time yesterday, China denied that there were any trade talks on any level of the government. So it's a bit of a he says, she says situation here. But going forward, I think it's a fast-moving situation, so we don't know if they will talk. I mean, President Trump said that President Xi Jinping called him, and based on the foreign ministry, they said that they hadn't heard anything like that. So it really is a situation where both sides are saying contradictory things.
Yeah, both of them seem to be saying it's your move, it's your turn to de-escalate. Alan, in the meantime, what is China doing beyond just the rhetoric of saying to the BRICS nations and emerging markets, let's come together? Beyond that, what is China doing to make sure that there is a limited impact to their economy as they continue to put up the tariff barriers?
There seems to be some move on China's part to grant exemptions to certain tariff exemptions to certain imports from the U.S. for example, certain industrial chemicals and maybe plane leases. So those are the categories that China may consider to be key to its own economy and the needs of domestic companies. So there are signs that China is moving to buffer those aspects of the economy.
Yeah, fair enough. And China also seeming willingly now to cooperate with Boeing. Alan, excellent work as always. It's always great to have you on. Bloomberg's Alan Wong. Coming up, more earnings, economic data on deck. We'll break down the calendar for you next on your Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. We're going to get more earnings before the bell, GM and JetBlue included. Plus JOLTS, that comes out at 10 a.m. Eastern. Visa and Starbucks, those earnings come out after the market close. Now some individual stock movers for you. Ford is rising the pre-market session with those concessions for auto tariffs being announced by Trump just by 1%. GM also rises. Same reason, it also has earnings before the bell, so maybe some tepidness to actually go in and buy before that. PayPal, they're also getting ready to report results. Those shares up 1.6 ahead of those figures. All right, that is it for Bloomberg Brief. Surveillance takes the reins from here. You're watching Bloomberg.